Hello and welcome to another session of the My Solo 401k Financial, My Community Daily Webinar Series. If you have questions or topics that you wish to discuss, please chat those over. We'll go through those questions or topics sequentially. The topic we brought to discuss today is unlocking the Backdoor Roth IRA with Vanguard, how to use reverse rollovers to avoid the Pro-Rata Rule. As always, the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Again, if you have questions or topics that you wish to discuss, please don't hesitate to chat it over. Let's dive into great, we got a top question. Actually, let's take this and then we'll turn to the topic at hand. Converting from employer-sponsored 401k to solo 401k as an S-Corp. Do previous employer-sponsored contributions need to be included into $70,000 contribution limit for 2025 with your plan? So it depends. So if someone is referring to a scenario where they have a 401k plan at a day job, and they make W-2 contributions to their day job 401k plan, those employee contributions that they make to their day job 401k plan will reduce how much the individual can contribute as an employee contribution. So for example, $23,500 limit for 2025 or more if you're age 50 or older, because you can make catch-up contributions. However, the employer contribution limit, the voluntary after-tax contribution limit, the overall limit of $70,000 is not reduced by contributions made to a day job plan. So it reduces the amount of employee contributions, but not employer, not after-tax, and not the overall limit of $70,000, for example, for 2025. So the exception to that rule, though, is the 403B exception. So any type of contribution that's made to a 403B, whether employee or employer, together with any contribution that the individual wants to make to the solo 401k, the sum cannot exceed the overall limit, for example, $70,000 for 2025. Hopefully that helps. Thank you so much for joining. All right, please, again, don't hesitate to chat over more questions or topics. Let's take a moment to go through the topic that we wanted to bring and share today, which again is unlocking the Backdoor Roth IRA with Vanguard, how to use reverse rollovers to avoid the pro-rata rule. So the context is a problem where high income earners cannot contribute directly to a Roth IRA. In other words, there are income limits above which one cannot make a Roth IRA contribution. Now, the solution for those individuals is to make a backdoor Roth IRA contribution. The issue with the backdoor Roth IRA contribution is a potential issue that arises when the individual has other pre-tax account balances in any type of IRA that the individual has, even another IRA. Because when they make that backdoor Roth IRA contribution, which is really a two-step process where they first make a non-deductible contribution to an IRA and then transfer the funds to a Roth IRA, hence the backdoor Roth IRA. When they transfer the funds, the non-deductible funds from their traditional IRA to the Roth IRA, they have to consider the pro-rata rule, which provides that they have to take a pro-rata share of all types of funds in any IRA that they have. So if they have other pre-tax funds, pre-existing funds in another IRA, when they go to the second step of the backdoor Roth IRA of moving the funds to the Roth IRA account, they'll have deemed to have transfer a proportionate share of the pre-tax funds along with the non-deductible funds. So it'll become a taxable event. Now, a possible solution, which is what we're here to talk about today, is a solo 401k. So how the solo 401k can facilitate a backdoor Roth IRA, specifically a Vanguard, by allowing the person to clean out their IRA, transfer the pre-tax funds to a solo 401k, thus enable them to be able to make a backdoor Roth IRA contribution that's not taxable. So we'll go over all the specifics, give you a step-by-step process, specifically using a solo 401k by my solo 401k Financial along with a backdoor Roth IRA contribution to an IRA at Vanguard. So again, let's lay the foundation by really understanding what a backdoor Roth IRA is. And so the context here are the income limitations above which one is not allowed to make a Roth IRA contribution. In other words, if you make too much money, the rules don't allow you to make a Roth IRA contribution. Now, the standard solution in that situation is the backdoor Roth IRA, where the individual would make a non-deductible, so an after-tax contribution to an IRA, step one, and then convert the funds to a Roth IRA, hence the backdoor Roth IRA. So they can't make that contribution directly to the Roth IRA, but they can make an after-tax contribution to a traditional IRA and then move the funds over to the Roth IRA. So why that works is that they ultimately will have those after-tax funds in their Roth IRA. Now, the pro-rata rule can complicate that. So under the pro-rata rule, one has to, when they get to step two, when they're converting the after-tax funds to their Roth IRA, they have to look at all their IRA account balances. So the pro-rata rule applies across all the IRAs that the individual has. And if they have other types of money, like pre-tax money in an IRA, let's assume that they had rolled over money, pre-tax money from a former employer plan to a rollover IRA. And then they make a non-deductible contribution to their traditional IRA at Vanguard. Then when they move the money from the traditional IRA at Vanguard to the Roth IRA at Vanguard, they'll be deemed to have transferred a pro-rata portion of their pre-tax money that was in another IRA. It could be another IRA somewhere else, at Fidelity or somewhere else, as well as the after-tax money that they just contributed to their traditional IRA at Vanguard. So ultimately, that'll create a taxable event. Let's assume that after they contribute that after-tax contribution to their IRA, 90% of the funds, when looking across all their IRA account balances, consists of pre-tax dollars. So when they go to move the after-tax contribution to their Roth IRA at Vanguard, 90% of the funds moved will be taxable under the pro-rata rule. So it becomes perhaps an unintended taxable event. This is where the solo 401k can potentially present a solution via a reverse rollover. So let's first lay the foundation with, okay, well, what is a solo 401k? A solo 401k is a 401k plan that's available to eligible self-employed individuals. So in order to be eligible, you need to be self-employed, meaning you're reporting earned self-employment income with no non-owner, non-spouse, full-time W-2 employees. So that's really self-employment income is going to be, for example, income reported on Schedule C on your 1040, W-2 wages that you might receive from your business taxed as an S Corp or a C Corp. So it's got to be from your own business, right? Not from W-2 wages that you receive at a day job. Or if you have a business that's taxed as a partnership, self-employment income would be income reported on line 14 of a K-1 from that partnership. Now, the second piece is not having any non-owner, non-spouse, full-time W-2 employees. So the individual themselves can be a W-2 employee. Their spouse can be a W-2 employee. They could have a business partner that's a W-2 employee. So what's going to prevent someone from being able to set up a solo 401k is if there is any business owned by that person or a spouse, if any, with non-owner, non-spouse, full-time W-2 employees. So if the person's eligible, they can set up a solo 401k. And then if they set up a solo 401k that accepts rollovers of pre-tax funds from an IRA, then they can process a reverse rollover. What's a reverse rollover? Well, typically you think of a rollover as transferring funds from an employer plan, like say a former employer plan, to an IRA, transferring those funds to a rollover IRA. So a reverse rollover is where you transfer funds from an IRA into a 401k. So it's the reverse. So if the individual is eligible to set up a solo 401k, they set up a solo 401k plan like the one offered by my solo 401k Financial that accepts the reverse rollover of pre-tax funds from an IRA. Now they could clean out their IRA. They could avoid the pro-rata rule, right? Because now they can move all their pre-tax dollars from their IRA into their solo 401k. So that'd be a non-taxable direct rollover, moving those pre-tax funds from the pre-tax IRA to the pre-tax solo 401k. Then they go to make the non-deductible contribution to their IRA, step 1 of the Backdoor Roth IRA strategy. And then when they get to step 2, all their money in all their IRA accounts just consists of those after-tax contributions. So it's not taxable when they move the money from the non-deductible contribution from their traditional IRA at Vanguard to the Roth IRA at Vanguard. So the key is being eligible. The key is working with a solo 401k provider like my solo 401k Financial that not only accepts reverse rollovers, but also has deep experience to help customers with those rollovers, right? We, for example, have helped thousands of customers roll over funds from hundreds of different institutions. And we've tracked that experience to create a deep knowledge base that we can tap to make the process easy for you, right? For example, completing the paperwork, et cetera, et cetera. So a step-by-step walkthrough would be first confirming self-employment eligibility, open a solo 401k with a solo 401k provider like my solo 401k Financial that accepts reverse rollovers, helps you with the transfer process, make the pre-tax, or I should say non-deductible contribution to your traditional IRA at Vanguard, move the non-deductible contribution over to your Roth IRA at Vanguard, and then work with your tax advisor to report it accordingly. All right, that takes us to the end of today's session. Thank you so much for joining. If you found this to be helpful, please like this video. It'll help us get the word out to other self-employed individuals, other freelancers, other solopreneurs just like you who may really value this information. They might be trying to catch up on their retirement savings. Also, we invite you to subscribe to our channels, whether on LinkedIn or Instagram or X or YouTube, as we do go live every single day. So you can come and hear the topics that we want to share, come and ask questions. So there's a lot of great ways to learn and to share the knowledge. So next question, I restated my account from Fidelity with my solo 401k and opened three identical accounts at Fidelity with the same name. Can I change the registrations? Example, Mr. Smith Trust for each separate account to add pre-tax, Roth, and after-tax on the actual registrations. Yes, you just go in there and nickname the accounts, exactly. Because from Fidelity's perspective, they're just providing the accounts for a third-party plan that you have through us. So they are not tracking whether one account is for pre-tax or another is for Roth or a third is for after-tax. So the key is just that you use the accounts consistently. So you can do exactly as you described. That's a great idea. If you look at the Fidelity email that we would have sent, there would be a link that describes step-by-step how to nickname the accounts, but you could just simply do it when you log into the account and just change the names. That'll help you keep track. That's a great, great question. Thank you so much for bringing it, and thank you for your business. We appreciate it. So if there's any more questions, please don't hesitate to chat it over. We want to invite you to our community. We have the largest community of solopreneurs, self-employed individuals around solo 401k plans. We've got over 30,000 members. It's totally free to join. All are welcome. You can join quickly and easily at mysolo401k.net/my community. We have forums. We have a library of videos and webinars. There's a lot of great resources there. Are Roth funds investments subject to any limitations, exceptions, as opposed to pre-tax account funds? Not from an investment perspective. So one's going to be able to invest in the same type of investments, regardless of whether those funds are pre-tax versus Roth. Great question. Thanks for bringing it. So it's prudent if someone is restating their plan to our plan, they're upgrading a basic solo 401k plan to our plan. There's no strict deadline, but it's prudent to transfer the cash and assets over sooner rather than later, just because that pre-existing account was set up for a plan that's been replaced with our plan. But there's no strict deadline to do so, but it's generally better to do it sooner rather than later. Of course, there's no deadline to transfer over funds from a former employer plan or a pre-tax IRA, although one is definitely eligible to do that. And we're here to help you with those types of transfers as well. So again, if you like the video, we'd really appreciate that. Help us get the word out. And we invite you to subscribe as well. All right, wonderful. Well, it looks like that might be taking us to the end of the session for today. Thank you so much for joining. Thank you for the great participation. Until next time.